Hello and welcome. In this video I show you 3 top dividend stocks to buy right now according to our more than 100,000 members who find their quality stocks on our website. And I will also tell you which of these 3 stocks is my personal favorite. And at the end of the video I even show you a bonus, the stocks number 4 till 10. So let's go. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Crash. It's all about long-term investing here to profit from capital gains and growing dividends as well. And stock number 1 is BlackRock, biggest asset management company in the world. What makes this stock so attractive to our members? I think it's the dividend yield and the quality of the stock itself. Current dividend yield is 3.1%, and this is more than you got previously. For example, in 21, dividend yield was below 2%, 1.7%, for example. Sometimes BlackRock touched dividend yield of 3% or even a little bit more sometimes, and that's mostly a good time to buy the stock, to invest in BlackRock. We also have growing dividends, and here you see the dividend growth in the past was about 12% annually. So dynamic dividend growth, 13 years of dividend increase also. And if you look here into the quality check, you can have the reported earnings, you see nice growth and also nice growth of the dividends in blue bar here. What we also see is, though, that BlackRock is a little bit cyclical. We have here declining earnings, and we also have declining earnings here during the financial crisis, 2008, 2009. This is due to the asset under management shrinking when the stock market goes down, and what also happened in 20, just recently, was the bond market also went down, interest rates went up, and the existing bonds, the quotes of the price of the existing bonds went down. So asset under management was shrinking, and people also withdrew money from BlackRock assets. So in 21 we still had asset under management of a little bit more than 10 trillion US dollar even. And in the end of 22, 1 year later, it was less than 8 trillion US dollar. Right now, it's going up again, but I'm optimistic that the turnaround succeeds, because we know from the stock market, especially the stock market and the asset under management of BlackRock, they are linked together. And we know that the stock market is a little bit cyclical, but in the long run, stock market goes up, and the same holds true for BlackRock as well. So let's check if the dividends are safe. We have the free cash flow here, and we see that dividends are still covered by free cash flow, although by a little bit thinner margin than before. We have here payout ratio based on free cash flow 77%. Based on earnings, it is better, it's just 56%. But I'm optimistic, like analysts, that free cash flow will soon go up again. And we also have a strong balance sheet. So if I just show you the most important positions, then we have the interest-bearing debt here. It's close to 10 billion, but we also have a lot of cash, and our liquidity is close to 7 billion. And we only have 3 billion dividends paid out within the last 4 quarters, and we have more than double cash. So we have enough cash in the balance sheet to pay dividends for more than 2 years. So even if something happens, I don't think so, that cash flow does not cover dividends completely anymore. There's enough cash here to continue paying dividends. So I'm very optimistic, or I think dividends are sure. Now it's the question if the stock itself is fairly valued or even undervalued. let's check this here in the fair value calculator. We have also a fair value based on dividends, and the dividends already indicate that the stock is undervalued. And this is how it looks like, because in the long run, within the last 10 years, average dividend yield of BlackRock was 2.4%, but now it's 3.1%, so much higher than in the past. And this indicates a fair value of about $120 compared to $640, which is the current stock price. So the stock seems very heavily undervalued, but this is not the complete truth, because you already can see it here. We have sluggish or even a little bit declining earnings on the one hand, but still growing dividends on the other hand. And this translates here into a gap which opened between these two fair values, fair value based on earnings and fair value based on dividends. In the past, they went very nicely hand in hand, but now there is this gap, and we should remove the fair value dividend and focus on the fair value based on earnings. What we see here is 2 periods of strong overvaluation of the BlackRock stock, 2018 and then till recently at the end of 21, where the stock price already reached close to $1,000, and then we had this strong correction from close to $1,000 to $600 and even below $600, $550. Now the stock price went up and down, a little bit volatile, but it's more or less didn't move in the longer run here, with the current stock price of $640. And we see that this stock price nearly represents the current fair value of $625. What makes the stock nearly fairly valued right now, but not completely undervalued as the high dividend yield suggests. Anyway, I'm very optimistic about BlackRock, and I'm also optimistic about BlackRock's future growth. The analysts indicate or estimate growth of about 12% for the business year 24 and 25, which is above the same as the long-term growth of the dividends. And this would result in an annual expected yield of 12% also. So already attractive and above market average for the market leader in asset management. And I'm not going to change the fair value calculation here. For me, it's okay with averages or average price earnings here of about 18 for growth rates of about 12%, which was already achieved in the past in several years, even higher, 19%, 18%, 19%. So it's realistic to me, and for me it looks an attractively valued high quality stock. Stock number 2 is called Johnson & Johnson, and here it is, Johnson & Johnson, 61 years of dividend increase, so it's a dividend king, emperor, or however it is called, but the dividend growth is only half of BlackRock with about 6% annual growth rate compared to 12%. But let's check it here. We also see, or what makes this stock so interesting, of course, sure dividends, at least if you look at this matrix. And like for the case of BlackRock, dividend yield is high with close to 3%. And it was just in 2015 when the dividend yield was even a little bit higher. And of course, analysts also predict growing dividends in the future. So this looks attractive also, but are dividends really safe? Let's find out. We have the adjusted earnings here, and it's nicely covered with payout ratio based on the adjusted earnings of 45%, which is less than BlackRock. And let's have a look at the free cash flow. Free cash flow went down. It's still covered, but it went down. There are no estimates for the free cash flow, but for the operating cash flow, and they go very smoothly on parallel. and you see that the operating cash flow should go up, so the free cash flow should go up as well. What's interesting here is if you look at the margins and the revenue, we see something which looks a little bit strange, because revenue should go down and the margins should go up. What's behind this? I will show you. We have here the different segments of Johnson & Johnson for the business years, and in 22 they still reported in 3 business segments, and the third business segment is consumer, and consumer is not anymore, does not belong anymore to Johnson & Johnson, or at least only partly, because there is a company called Kenvue, and we can also show this company to you. Edit Kenvue, and here it is, and this is the former segment, the former consumer segment of Johnson & Johnson. Is this? Can even show you, if you look here at the complete revenue of the segment, it was 40.95 billion this year, and if you look here at Kenvue, the segment, you see the 40.95 billion here again, even a little bit more in detail here, because this is at a company level and this is a segment level. So, and this segment is now an own company you can invest in, but which was not such a fortunate investment so far. You see that the stock is below the IPO, the current stock price. Anyway, let's go back to Johnson & Johnson. And if we have these 3 segments here, and now we want to know, is it favorable for Johnson & Johnson that they get rid of this segment or not? And we have this consumer segment here, and you see that there's no growth in sales at all. Since 2012, there was no growth in sales at all in this segment. So from this point of view, it was not an outperformer, and also the margins about close to 20% in the last business year. But if you look at the business year in 21, it was only 9%, and it was even negative in 20, which might be related to these asbestos litigation in the baby powder. And at least we see that the margins are not really stable, and especially if we compare to pharmaceutical, margins are close to double as high, with 30%, and pharmaceuticals, here you see visually that there is growth, while consumer there's no growth at all, and we have even higher margins also in pharmaceutical compared to consumer. So consumer is was a weak segment for Johnson & Johnson. Compared to pharmaceutical, and medical devices is also not a really growing segment, with even a little bit partly at least or with similar margins in the consumer segment. So you see pharmaceutical is by far the best segment of Johnson & Johnson, and luckily it is also the largest segment, and the new Johnson & Johnson looks like this. So this explains why margins should go up and sales should go down. We can also look at the balance sheet, and just a very short way here, because of the declining free cash flow, amortization power also goes down. But what we see here is dividends paid out in the last 4 quarters of 12 billion, and we have a cash of 28.5 billion, so more than 2 years of cash, more than 2 years of dividend payments in the balance sheet. So dividends are sure, in my point of view. Let's go to stock number 3, and stock number 3 is Coca-Cola. And Coca-Cola, it's like this. So if we add Coca-Cola, we write like this. You see that there are many Coca-Cola companies, Coca-Cola, like this. So you see there are all these bottlers, or how they are called, who fill the Coke into a bottle. You can also invest in these. They are also nice dividend payers. Some of them higher capital gains as Coca-Cola, the main company, but this would be something for another video. Now, this is stock number 3, it's Coca-Cola, and it's also a dividend aristocrat or king. 60 years of dividend increase, the same as Johnson & Johnson, by the way. But we see here that dividend growth is relatively sluggish. It's even below Johnson & Johnson. What makes it so attractive? Short dividends, obviously, at least regarding to these metrics, but also here that the current dividend yield also looks attractive, 3.4%. Not long ago it was below 3% till 2.6%. Sometimes it was a little bit higher, but if we at corridor here, you see that it's in the upper range of the corridor. It's a 2-year corridor, so it looks attractively valued right now according to dividends. And let's check if dividends are safe. We can do it here in the quality check, and here we have the adjusted earnings. We also can add the free cash flow, and dividends are covered by both of these metrics. Payouts between 17 and 83%. And let's see here at the most interesting positions in the balance sheet. Here you see that cash is not only covers a part of interest-bearing debt. That was better for the 2 previous stocks, BlackRock and Johnson & Johnson. But anyway, we have cash, 50.7 billion, and dividend payments a little bit less than 6 billion. So also in this case, we have enough cash in the balance sheet to pay dividends for more than 2 years. So, and what's also important is that we have difficult situation right now with this inflation and with rising costs, and you can also see it here in the profit and loss calculation. If you would really, if you would really dive in there, or you could also see it in the margins. Should be slight margin pressure here. You see it's but only very slight margin pressure, very slight. They are only very slight because management does very well. Same like PepsiCo, by the way. They increase price, they make big price increases in double-digit rates even, and consumers still buy the beverages like Coca-Cola. And so their business model works, and their business model is bulletproof even if in times of high inflation and in times of pending recession at least. And management increases its guidance each quarter. Anyway, the fair value or the stock price went down. You can see it here, and this might make it a nice buy right now. If we add the fair value dividend, then you can see the same as, for example, we saw for BlackRock. High, or the stock looks undervalued right now. Stock price, fair value dividend, $59 compared to close to $54. But if we add the fair value based on, it was price to sales, price to adjusted earnings, let's take this. Then you can see it goes hand in hand. The both fair values go hand in hand for the estimated fair values. They differ a little bit more here in the past because the earnings, or even the adjusted earnings here, you see they went partly even down while dividends still were increased. You can see it here, dividends were increased, earnings went down, so they differed very much, but in the future they should go hand in hand. Anyway, let's concentrate on the fair value based on adjusted earnings, and we see a typical picture here, times of over and times of undervaluation, while overvaluation was more common for Coca-Cola. We have for Coca-Cola multiples which are higher in the past and today than, for example, for BlackRock, while earnings is not as fast, even also estimated earnings are not growing that fast, not that dynamic as, for example, BlackRock. with estimated growth rates in the middle double-digit rate. Anyway, we have here a fair value of $59 and the $54 current stock price. They make the stock, and it looks like the stock is undervalued right now. So let's check about the expected yield, annual yield, by comparing current stock price to estimated fair value in 26, which would be close to $70. And this would be all-time high because currently the stock was already valued as high as 66 US dollar, 69 US dollar would be a new all-time high. Then we would have an annual yield of 11%. But in my point of view, 22 price earnings is a little bit too high maybe for a stock like Coca-Cola, which is really a slow grower. And I would adjust the fair value calculation at least a little bit to, let's say, 20 or at least 27. Then we have the market valuation, which is currently 27 as well. And then we have an expected yield, annual yield of 8.7%, which is still above the market average. So it still looks attractively valued. So these are the 3 stocks, top dividend stocks to invest right now, according to our members. My favorite is BlackRock because it has the most dynamic growth, and I think has a very good risk-reward ratio, and is a good stock suited for people who prefer dividend growth to dividend income. Of course, if you prefer dividend income, then Coca-Cola or Johnson & Johnson could be also very interesting to you. And I promised you a bonus, and you get it, and it is here. Here we have the top 3 stocks we were just analyzing, and now you see which other stocks are also hot according to our members, which is Unilever place 4, and then you see all the others. What does these numbers mean? These are the buy limits of our members, and we said the more buy limits a stock has, the more requested it is, and the stock with the highest buy limits, 837, is BlackRock. So this is why BlackRock was the #1 stock to buy right now, and it's also my favorite stock. Okay, that's it. You know the top, not only 3, but top 10 dividend stocks to buy right now. Of course, you can always consult our screener, and there you find many more stocks to buy right now because they are of high quality and fairly or even undervalued. Thanks for watching. See you next time. Bye bye.